Uganda, like a number of developing economies, is swimming against many odds to keep the economy buoyant. A major threat today is climate change, given its immense impact on agriculture, which is a major sustainer of most households in Uganda and a critical contributor to the economy.
The domestic shocks are mainly climate change related, where the drought has hit agriculture, and agriculture in the price index is one of the biggest items besides fuel. So you find that when that big item of food is hit by drought, it has got implications on the supply of food in the country. And if the supply drops, even with the constant demand domestically of the same number of people consuming the same amount of commodities, you find that the price gap comes up, and that contributes a lot to inflation. That is the big domestic shock that we have got.
But even of critical concern for Uganda is the impact climate change has had on fossil oil investments, with experts now worried after the country seems to have anchored much hope on the oil subsector, which recently attracted a final investment decision from major players.
Climate change effects, which already the previous presenters have hinted on. These have resulted in a gradual withdrawal of financing to non-renewable energy projects. The president, when he was addressing the country recently, he gave us an update on the drop in the level of investment in fossil energy explorations. New explorations are now not coming on board as fast as they were because of the climate change effect, and this has an effect on us.
At the bigger stage, Uganda's economic observers worry about the monetary policy stance being taken by global players, which they fear might dampen economic activity, especially lending and borrowing.
In a bid to tame the inflation, countries have increased the interest rates. In USA, for example, the benchmark rate have gone up to around 2.25 to 2.5%. This is the highest they have seen in the US since 2008. Similarly, in the UK, their benchmark rate now is about 1.75%, one of the highest since 2008. The implication of this is increase the cost of borrowing on us, because now the finances, the global financial market is looking at those markets which are quite more expansive and safer. And also it has reduced our access to the capital, as I said, due to the reversal or the reversed flow of the capital.
One of the major interventions government is fostering to drive growth and retouch the economic outlook is the parish development model, which among others looks to turn around the agricultural sector and participants' model of operation to sync with the changing times.
In the medium term, we expect the parish development model to have significant effect on the growth of this economy. The PDM is a multi-sectoral strategic intervention by this government to create socio-economic transformation by moving 39% of Ugandan households still stuck in a subsistence existence to the money economy. It is expected to boost food production for sure, contribute to value chain development and marketing.
Today, as the world reels with the COVID impact, which is a major contributor to some of the economic doldrums we are contending with, experts assert that keeping economies like Uganda afloat will, among others, take efficiency in domestic resource mobilization, tax administration, and utilization as we await the global resources space to stabilize.